The Bollinger Band is a powerful technical indicator formulated by John Bollinger around 1980s. The band consists of three lines, the middle line being a moving average and the above and below line being connected to the moving average by an indicator called the standard deviation. Now, the middle line is generally a 20-day simple moving average, and the top and bottom bands are two standard deviations away from the middle line. The distance between the top and bottom lines is called the bandwidth. I will be showing you this indicator shortly when this concept will become clearer. So here is a chart of the Nifty futures of the current month. And I'm now going to plot the Bollinger Band on this by going to the indicator window and going to Bollinger Band. So it is a 20 time period Bollinger Band with the up and down deviations being two standard deviations from the mean. This is what the Bollinger Band looks like. Moving on, let us understand the concept of the standard deviation. So the standard deviation measures how spread numbers are in a data set. In other words, how spread apart are the closing prices of a given stock or an asset. So it shows the average distance of each data point from the mean, which is the moving average. And basically, a low standard deviation means that the closing prices are close to the mean. In other words, they are constricted. So we are in a low volatility period as compared to a high standard deviation where the lines are spread out, the prices are spread out, and therefore we are in a high volatility scenario. So it is commonly used in statistics, finance, and quality control. Now, normally, if a stock price is at 100 rupees and it has an annualized standard deviation or an annualized volatility of 10%, then we can use this to estimate the expected range of the price over a year. Based on basic statistical theory, we can say that the price will be 10% lower than 100 or 10% higher than 100, that is 90 to 110 with a 68% confidence interval. So this essentially represents one standard deviation. If we go to two standard deviations, then it will be 100 plus or minus 20%, which will be 80 to 120. And this we can say with a 95% confidence level. Three standard deviation would mean 100 plus minus 30, which is 70 to 130, which is a 99.7% confidence level. Since 95% is considered enough for all practical cases, two standard deviations are used. And therefore, John Bollinger used two standard deviations away from the mean to calculate the bands of the Bollinger Band. Moving on to the usage of the band. The band essentially, as I told you, consists of a moving average with a top line and a bottom line. The distance between the two is called the bandwidth. Now, when the market is volatile, the bands widen. When the market is calm or in a trading range, they contract. So basically, the widening and the contraction of the band helps traders to spot shifts in momentum and potential breakouts. Remember that if a widening band shows inclination of becoming thinner, this is a sign that we may be moving from a trending market to a trading range market and vice versa. So this could also be used for buying and selling options. Buying options is normally done in a trending market, while selling options is normally done in a trading range market, in order to ensure that the time value is not offset by the price movement of the stock. Now, coming to the next point, when price touches the upper band, a lot of traders think it might be overbought. And when it touches the lower band, they think it might be oversold. But the word overbought and oversold are not valid in all markets. They are valid only in a trading range market. And it is only in a trading range market that signs of mean reversion may occur, which is why the top of the band may be considered as overbought and the bottom may be considered as oversold only if we are in a trading range market. In a trending market, a breakout from the band will give us a trading signal. So the Bollinger Band is a trading tool, and a breakout from the top of the band gives us a buy signal, from the bottom of the band gives us a sell signal. In a trending market, a band breakout can therefore signal strength and continuation. Now, John Bollinger said that if prices exit the band, then buy, and if prices go below the band, sell. This can lead to a bit of confusion if we look at actual charts. Now here, if you look at the Bollinger Band, which I've drawn on the chart of the Nifty, you can see that if I use the normal Bollinger Band as formulated by John Bollinger, where are you finding that the prices are exiting the band? The reason why prices are not exiting the band is that when prices start moving, the band, which is based on a moving average of the prices, also starts moving with the band. So this is equivalent to you're sitting inside a plane which is completely isolated from the outside world. Whether the plane is on the ground or whether it is taking off will not be known to you unless you have a reference point. When we sit in a plane, we know that we are taking off. When we look outside, we see that the ground is moving away from us. Now, if I take the normal Bollinger Band and offset it by half the time period of the moving average, in this case 10 periods, then essentially what I'm doing is I'm catching the band and pulling it forward so that previous values of the band, which were an earlier reference, are now above the current value of the prices. If you look at the chart in front of you, you will see how clearly a buy signal came here as compared to no signal coming here. This is an offset Bollinger Band, whereas this is a normal Bollinger Band. Again, take a look at another example where here we had a huge downfall and the band kept staying with the prices without giving you any definitive or concrete signal. If I offset the band by 10 periods, then previous values of the band come above or below the current value of the prices, and look at the clarity with which you got a sell signal. So here is something fantastic which you can use, which is an offset Bollinger Band. An offset Bollinger Band will give you crystal clear trading signals. When we exit the offset band in either direction, a trade is to be initiated the next day. If we break upwards, we buy at the opening of the next candle, keeping the lowest low of the last 3 candles as the stop loss. If we break downwards, we short at the opening of the next candle, keeping the high of the last 3 candles as the stop loss. The target is to be determined either by a Fibonacci retracement or a Fibonacci projection, depending on as the case may be, or by the top of the band without an offset, where a reversal pattern occurs. This is the method of trading with a Bollinger Band which is offset. Here is the Pine code for plotting an offset Bollinger Band in TradingView. The same has been given in our description below, and you may copy and paste this into TradingView for plotting the same. Another way of using the band would be to use it as a dynamic overbought oversold level in momentum oscillators. Momentum oscillators like the RSI have a fixed overbought and oversold level 70 and 30. Many a time we find that the value of the RSI changes its direction, especially in a trading range, much above 30 or much below 70. If instead of using the static bands, I use a dynamic band by plotting a Bollinger Band on the indicator, look at the accuracy with which overbought and oversold levels were caught. Here we were in a trading range. Look at how the bottom of the oscillators tallied with the bottom of the market. So basically, the Bollinger Band can be used as a dynamic overbought oversold indicator for momentum oscillators. These were 2 unique methods of using the Bollinger Band. So we have learned some unique ways of using the Bollinger Band, and I hope that by using these methods, you will be able to get better trades in the market and have a higher percentage of winning trades. Kindly refer to the book by John Bollinger called Bollinger Bands, which is obviously the authoritative book on the subject. With this, we close this video, and questions will be solicited in the comment section. I will answer all questions which are posted there. Thank you till we meet in our next video. Till then, please like, subscribe and share this video with as many people as you can, so that this channel is able to provide you with more and more videos of a high quality. Thank you.